Hello and welcome to Finance Conversation. This is the ninth episode of the Merging Life and Money show, and I am super excited to be here with you. If we are meeting for the first time, I am your host, Marie-Jo César. I help frustrated professional women take control of their finances from the inside out and live their best life with the money they have. Thank you for joining in today. If you are watching the replay, make sure to type #replay in the chat and leave me some comments and questions. Welcome, welcome, and welcome. I come live every Thursday at 5 p.m. Pacific Standard Time to share valuable information about how to achieve financial wellness and live your life with means and meaning. Today's show is the 8th in the series titled How to Build a Secure Financial Plan. I will be exploring step 7 of the process, which is the basics of investing. It is going to be pretty heavy, I think, so grab a pen and a notebook as I will be sharing tips and ideas that you might want to write down. And if you have any comments or questions, make sure to put them in the chat. And if you want to talk to me directly, I will share my contact information later in the show. So far in the series, How to Build a Secure Financial Plan, I talked about 5 keys: financial mindset, budgeting, debt, savings, insurance, and retirement. But now, if you understood all the steps I spoke about in the past 8 weeks or so, you should be getting ready to make the necessary moves to take your finances up a notch. Remember that meaningful changes and transformation happen over time, not overnight. So make sure to review your notes from the previous shows to ascertain that all the parts of your financial house are in order. If you did not take any notes, don't worry. I will have a summary for each show available very soon. In fact, I will drop the links in next week's show. Let's review what you should be working on right now. You should have an emergency fund set up with the right number of months and adjusting or setting up your budget that would facilitate funding it, right? You should have, you should be making plans to have all your credit cards paid off in full sooner rather than later. You should decide or make a plan to pay all outstanding debt on time. You should also have plan to have a retirement system and maxing out the minimum contribution you could put in. And lastly, you should plan to have money saved to start investing soon. And I would recommend a minimum of about $1,000. Therefore, you should be able to start investing once you complete the 5 actions I just stated. And today, I will share information about the basics of investing, which will enable you to take your finances to the next level. Up until now, I focused on the money you earn by working. And now I want to talk about the money you can make without working. And trust me, it is nothing illegal. It is the income that your money earns for you. While our lives are powered by money, it does not revolve around it. And the more money we have, the more we can do. But how do we get more? And how do we explain that some people are able to grow their money and some aren't? Guess what? Those who can have embraced the concept of investing. If you recall, for last week, I talked about retirement planning and the fact that you will likely live a long life, and whatever your age, you plan to enjoy life as long as you have it. So you will be supporting yourself for a quarter of your life, without the benefit of a regular salary, and it may take some work to figure out how to make your money work as hard as you do. But you must find a way. And this is why I am talking about investing today. The investment world is huge, and the only way to get a handle on it is to start now if you have not done so. If you are not putting your money to work, you need to find a course, read a book, go and listen to my show again, or even put your phone out and talk to Google Assistant, do something. But you got to learn, and you got to learn because remaining ignorant is not the answer. It is a choice that hopefully you have not made because you are here. So I will focus on 3 points today, and they are understanding investing and why it's important, what you should invest in and how to start investing, and lastly, I will end the show with a brief history about investing. Before getting into it, let me explain the difference between saving and investing. Many of you are reluctant to invest money because you think the stock market is too risky and you rather save, right? Well, people commonly use the words savings and investing interchangeably, and there are notable differences between the two. Saving typically means putting aside money in low-risk savings account, money market fund, CDs for short-term goals, such as buying a car, taking a family vacation, or establishing an emergency fund. It is money you want to be able to get to quickly, easily, and with little or no risk to lose what you set aside. Investing, on the other hand, is the act of allocating resources, usually money, with the expectation of generating an income or a profit. Typically, it assists with financing your long-term goals, such as paying for college education or funding your retirement. The expectation of a return in the form of income or price appreciation is a core premise of investing. Okay, so the spectrum of assets in which you can invest and earn a return is a very, very wide one. As mentioned earlier, once you have established your solid foundation and you accumulated enough cash reserve to meet your emergency, you should be looking at investment vehicles that will increase the earning power of your dollars. So you will be putting your money into the stock market to increase your yields, participate in capital appreciation, and share in the corporate wealth of America, as well as companies around the world. Successful investors establish an investment plan and stick to it over a long period of time. The market fluctuates like crazy in the short run, but over time, those cycles average out, and long-term trends show that double-digit returns are possible. The records show that investing in the stock market is well worth the risk. So go ahead, take the plunge, and dispel the myth that Wall Street is nothing more than a grand casino in which the house always wins. But what about the risk, you would ask? Risk and return go hand in hand in investing. Anyone who claims otherwise is either naive or trying to sell a lie. Low risk generally mean low expected returns, while higher returns are usually associated with higher risk. Even so-called low risk or no risk savings alternative involve risk, okay? So let's look at the most important type of risk you are likely to encounter when investing. Market risk, the first one. The prices of stock, bonds, mutual fund, real estate, gold, or other investment assets rise and fall due to the economy, due to investor sentiment, due to political events, changing interest rates, changing the fortunes of companies or industries, and many other factors. All investment assets fluctuate to some extent. This is the type of risk people associate the most when investing. Well, I should say they associate to the most with investing. The other one is inflation risk. Inflation, sorry, basically means that a dollar tomorrow is worth less than a dollar today. So inflation is a silent thief that over time can rob you blind. Okay, it can rob your savings of significant buying power. In addition to understanding the different type of risk, it is important to understand that the willingness and the ability to withstand short-term prices fluctuation generate greater long-term reward. So stocks fluctuate more than CDs, for example. And so with stock, you can lose part or even all of your investment in a short period of time. Yet, over the long term, stocks on average have consistently and substantially outperformed cash and the thief of cash, inflation. So, how to control risks? If accepting greater risk is one of the necessities of investing, then one of the keys to investing is controlling risk. Okay, so I put together there are basically 5 strategies that must be understood. Okay, and I'm going to name them: diversification, asset allocation, dollar cost averaging, time and its best payout, compounding interest, and rebalancing. So I'm going to take a look at each of them. Diversifying your investment means never putting all your eggs into one basket. A well-balanced investment portfolio involves spreading investment fund among different types of assets. Asset allocation is an investment strategy that aims to balance risk and reward by apportioning a portfolio's asset according to your goals, to your risk tolerance, and your investment time horizon. It is a most important decision that we make, that you will make the most. Okay, and I'm repeating. This is the most important decision that you will make with respect to your investment, as it accounts for 90% of your returns. Another one is dollar cost averaging. Through this investment strategy, you can protect yourself from the risk of investing all of your money at the wrong time by following a consistent pattern of adding money to your investment over a period of time. By making regular investment with the same amount of money each time, you will buy more of an investment when its price is low and less of the investment when its price is high. Let me take a bit of water here. Another one of those investment strategies to combat risk is time. Time happens to be compound interest best buddy. It plays a significant role when it comes to investing. It can give you more control over your investment. It can increase your tolerance for risk and your ability to recover from any losses, and it can maximize your returns. So start early, invest wisely, and give yourself the time you need to reach your goals, and you will discover the positive impact that a little bit of planning today will have on your lifestyle in the future. Last but not least is rebalancing. Rebalancing is bringing your portfolio back to your original asset allocation mix. By rebalancing, You will ensure that your portfolio does not overemphasize one or more asset categories, and you will return your portfolio to a comfortable level of risk. Now that we dealt with risk and the strategies that exist to combat risk, let's take a look at the type of investments. There are many types of investment, but the most common one are three: stocks, bonds, and cash equivalent. So let's look at stock. A stock is an investment in a specific company. So when you purchase a stock, you are buying a share, a small piece of that company's earning and assets. For companies issuing stock, for companies, I should say, issuing stocks is a way to raise money to grow and invest in their business. For you, the investors, stocks are a way to grow your money and outpace inflation over time. So stock investors make money when the value of the stock they own goes up and they are able to sell that stock for a profit. So some stocks also pay dividends, which are regular distributions of a company's earning to the investors. Now, bonds, and I'm trying to simplify those as much as possible. And please put some question in the chat if you have any. As I said, those kind of talks are never sexy talks, but they are very important, and that's a good source of knowledge for you if you want to enter in the proverbial investment club. A bond. Let's look at bonds. A bond is an IOU. When you invest in a bond, you are lending money to a company or the government that promises, not necessarily guarantees, that it will pay back your principal with interest. Bonds include treasury bonds, municipal bonds, and corporate bonds. Bonds are what you call fixed income investments because investors expect regular income payments. Interest is generally paid to investor in regular installment, typically once or twice a year, or a lot of companies do pay the interest on a quarterly basis as well. And the total principal is paid off when the bond matures. Okay, so at the bond's maturity date. The other type of investment is cash equivalent. Cash equivalent investment protect your original investment and let you have access to your money. Some examples are savings accounts, money market accounts, and CDs, certificate of deposit. These different type of investment generally deliver a more stable rate of return, but cash equivalent investment are not designed for long-term investment goals, such as retirement. After tax are paid, the rate of return is often so low that it doesn't keep pace with inflation. So if you want a place to park some money that you're going to be using properly, you could use one of those instruments. Other type of investment include real estate, your home, or any commercial property that you may have, precious metals such as gold and silver, and energy. And by energy, I mean oil and gas. Now, let's look at investment products. They are not investment type, they are investment products. They are made with those investment type. The first one that I'm looking at is funds. Funds are pooled instruments managed by investment managers that enable you, the investor, to invest in stocks, bonds, preferred shares, commodity, etc. It's a number of investment type that you could invest, that they could use to create an investment product. The two most common type of funds are mutual funds and exchange traded fund or ETFs. Mutual funds do not trade on an exchange and are valued at the end of the trading day. ETFs trade on the stock exchange, and like stock, they are valued constantly throughout the day. So mutual fund and ETFs can either passively track indices such as the SP 500 or the Dow Jones, or can be actively managed by fund managers. So when investing in fund, be aware of the fees they charge. Mutual fund and exchange traded funds are valuable tools for long-term investment. They are managed by a professional whose main focus is building the value of the fund, helping you to diversify your portfolio, and enabling you to buy into companies and securities that you may not have been able to on your own. So as beneficial as it is to invest in this kind of funds, they also cost money. Though both mutual fund and ETFs are considered low-cost investment products, you will find a number of fees associated with managing a fund on your behalf. The main fee you should know before signing any paperwork is the expense ratio. It is a measure of mutual fund operating costs relative to assets. So you must pay attention to it to better determine if a fund is an appropriate investment for you after fees are considered. Another type of investment product is what they call investment trust. Trusts are another type of pooled investment with real estate investment trust, or they call them REITs. They are the most popular in that category. Okay, REITs invest in commercial or residential properties and pay a regular distribution to their investors from the rental income received from the properties that they invested in. REITs trade on the stock exchange and then offer the investors the advantage of instant liquidity. If you own a house, you cannot just pull out a window or cut a piece of the roof and go turn it in for cash. So if you like to invest into real estate without having to deal with the structure itself, a REITs would be a good alternative. But do your homework. Check it out. Another one is alternative investment. This is a catch-all category that includes hedge funds and private equity. And I know I'm getting into some pretty deep concept of investing, but you must know that because it's part of the language now. So hedge funds are so-called because they can hedge their investment bets by going long and short on stocks or other investment. Don't worry if this does not mean too much to you. It is an advanced strategy used by experienced traders and experienced investors. But you got to know about that because I'm sure you hear a lot about hedge funds. Private equity enable companies to raise capital without going public. So hedge funds and private equity were typically only available to affluent investors before. They had to make a certain income and a certain net worth in order to be able to be invited at the table. So, however, in recent years, alternative investment have been introduced in fund formats that are accessible to retail investors. The next one, we're getting deeper into this. There are options and derivatives. Derivatives are financial instruments that derive their value from another instrument, such as a stock on index. Option is a popular derivative that gives the buyer the right but not the obligation to buy or sell a security at a fixed price within a specific time period. So derivatives usually employ something called leverage, making them high risk but high reward propositions. Leverage, by the way, is an investment strategy of using borrowed money to increase the potential return of an investment. The last one that I want to touch on is something called commodities. Commodities include metals, oil, grain, and animal products, as well as financial instruments and currencies. They can either be traded through commodity futures, which are agreements to buy or sell specific quantity of a commodity at a specified price on a particular future date, or they could also be traded on through the ETFs, the exchange traded funds. Now, that was that for investment product. And again, not to be confused with investment types. Now that you heard about the most common types and investment product, I want to mention the most common investment styles. It's not too many of them. You have the active versus passive investing. The goal of active investing is to beat the index by actively managing the investment portfolio. And passive investing, on the other hand, advocate a passive approach such as buying an index fund in tacit recognition of the fact that it is difficult to beat the market consistently. While there are pros and cons to both approaches, in reality, few fund managers beat their benchmark consistently enough to justify the higher cost of active management. But some people like active management, and I'm one of them. Another investment approach is or style is growth versus value. Growth investors seek companies that offer strong earnings, while value investors seek stock that appear to be undervalued in the marketplace. Because the two styles complement each other, they can help add diversification to your portfolio when used together. Now that we've looked at the various investment type and product, how do you go about purchasing investment? Well, no matter what you invest in, you need a brokerage account. And like a bank account, a brokerage account allows you to buy and sell investment. Account can be opened at a full-service brokerage firm or at a discount broker or through a financial planner who is also securities licensed. So you can open a brokerage account in as little as 15 minutes. And once you fund it, you'll be ready to begin investing. Do your research first, though. By the way, there should be no fees to open a brokerage account. So once you understand the fundamentals of investing, you can then develop an investment plan or strategy. And this involves the following. First, clarifying your goals, such as early retirement, current income, or saving for college education. Okay, you have to know how much money you will need to achieve these goals and how much time do you have to achieve these goals. So be as specific as possible. Next, define your investment objectives. What type of investment and what investment product will help you reach your goals. If you have 30 years to retirement, you may want to consider investing the majority of your funds in an aggressive growth mutual fund through your 401k plan because they offer capital appreciation. And you will have time to ride out the ups and downs of the market if you are approaching retirement. Excuse me. So I was saying, if you are approaching retirement, you may want to consider fewer volatile investment that will provide high current income, but you still need some growth fund in your portfolio to stay ahead of inflation during your retirement years. So being retired doesn't mean that you can no longer invest. Okay, so make sure that you do have a little bit of growth investment in your portfolio while you are retired. Whether you are trying to reach one goal or several, the combination of investment you make is called a portfolio. So your plan should state what percentage of your total portfolio will consist of stocks, bonds, cash or cash equivalents. You may decide to have some international investment in there, some precious metals, a little bit of real estate, a little bit of cryptocurrencies, and or other type of investment you choose. So how much you allocate to each category will depend on your goals, on your risk tolerance, or on your time horizon to that goal, on your age, and on the amount of funds you are prepared to invest. So a diversified portfolio is more likely to reduce risk and stabilize return. So don't forget cryptocurrencies. I couldn't help it. I had to get into there because this week, Elon Musk, Mr. Tesla, the second richest man in the world, just announced that he sold 272 million worth of digital asset during the first 3 months of 2021 and netted 110 million from the sale, which represented about 10% of its holding at that time. So, and I don't know if you remember, because I keep my ears to the ground, in February, he announced that he bought 1.5 billion worth of Bitcoins. So anyway, Bitcoin, that's a conversation for another day. Finally, I want to talk about a piece of the history of investing very quickly. I promise I won't be long. So while the concept of investing has been around for millennia, investing in its present form traces its roots back to the period between the 17th and the 18th centuries, when the development of the first public market connected investors with investment opportunities. At that time, the first recognized stock exchange was the Amsterdam Stock Exchange. It was established in 1787. And this was quickly followed by the New York Stock Exchange in 1792. And believe it or not, the New York Stock Exchange is the largest equity-based exchange in the world, based on the total of market capitalization of its listed securities. And formerly, the New York Stock Exchange market was ran as a private organization, and it became a public entity only in March of 2006. So invested in its present format has been around for way more than 200 years, right? So I will stop here today and do a quick recap. I shared a lot of information about understanding investment that I know. I talk about a lot of things, and it took me quite a while to scrub all these investment terms and all that and try to break it down and put it in everybody's language. The concept, I touch on the concept of investing. I touch on the risk associated with investing. I talk about the 5 investment strategies that any investor should know when it comes to mitigating risk. The 3 investment types. I talk about the number of investment products currently available, the main investing style or approaches, whatever you want to call it, how to go about purchasing investment, and I just talked about very briefly about the advent of the stock exchanges. So before I forget, let me share my contact information. You can reach me by sending me an email at mj@mariejocesar.com or by sending me direct message via Facebook Messenger. I'm going to leave you with this last point. A well thought out investment plan is critical because you still use it to monitor your progress. It also keeps you steady through good and bad and help you avoid those tempting hot investment that really do not fit your needs. You all remember GameStop a couple of months ago. By the way, if you decide to work with an investment advisor, make sure the advisor helps you develop a written investment policy statement. It specifies your investment goals, risk tolerance, acceptable asset classes, and investment performance measurement criteria. Okay? So I would strongly recommend that you listen to the replay if you are seriously considering joining the proverbial investment club. And as you know, I like to end the show with a quote. And today I chose one from T. Harv Eker, the author of the book titled Secrets of the Millionaire Mind. And it reads, "Poor people see a dollar as a dollar to trade for something they want right now. Rich people see every dollar as a seed that can be planted to earn $100 more, then replanted to earn $1,000 more." Okay? So I'm going to leave you with that. And for more information about how to continue building a secure financial plan, join me next Thursday at 5 p.m. Pacific Standard Time, 6 p.m. Central Time, 8 p.m. Eastern Standard Time, 9 p.m. Atlantic Time. I can't even say it. That's for my peeps in Bermuda. And I will be talking about step 8, which is estate planning. Well, guys, you can't take it with you, but you got to plan for it. Okay? So thank you for being here today on the Merging Life and Money Show. I am your host, Marie-Jo Cesar. I will be back again next week. Until then, continue merging life and money. Bye for now.